lot of business owners think the purchase price is the purchase price. They say, well, we agreed on $2 million, done. But here's what most buyers don't realize until it's too late. How the purchase price is allocated can be just as important as the price itself, because allocation affects how much tax the seller pays, how many deductions the buyer gets, and what cash flow looks like after closing. So let's keep this simple. Purchase price allocation is the process of assigning the total price you pay across the categories of value you're buying. This most often shows up in an asset deal because you're purchasing specific assets, not just the entire entity. And here's the buyer question that matters. How much of what you're paying will turn into tax deductions later, and just how fast? Now, there are four main buckets you're usually dealing with. One is working capital items. These are things like cash, receivables, inventory, and payables. This isn't just paperwork, it directly affects cash flow right after closing. If receivables are slow, inventory is outdated, or payables are due immediately, you can feel cash poor even when the business looks profitable on paper. 2, tangible assets. That means equipment, vehicles, furniture, improvements. Buyers tend to like this bucket because it can create depreciation deductions. Depreciation can reduce taxable income, which can improve after-tax cash flow. But this only works if the assets are properly identified, the values are reasonable, and the buyer can document what was acquired. Number 3, identifiable intangible assets. Things like customer lists, trade names, contracts, non-competing agreements, proprietary processes. Many intangibles can be amortized over time, so they can also create deductions, but the classification matters, and this is where buyer and seller goals often collide. Number 4, goodwill. Goodwill is basically the extra value you pay that isn't tied to a specific asset. The reputation, the going concern value, the assembled workforce, and the expectation the business will keep producing earnings. Goodwill is common, but the deductions are typically slower than what buyers hope for. And here's why this matters. If your allocation creates faster deductions, taxable income can be lower sooner, which can support cash flow. If most of the price ends up in goodwill, deductions are slower, and your early year after-tax cash flow may be tighter, especially if you're financing the deal and have payments right away. Where deals get quietly expensive. Here are the top reasons owners get surprised. Allocation is decided too late, after the leverage is gone. Buyer and seller have opposing tax goals. Buyers assume they'll get huge depreciation, but assets aren't well documented. Working capital isn't defined clearly, so the buyer has to rebuild it after closing. Sometimes no one models the after-tax result alongside the financing, so the practical steps are: discuss allocation early, not at the last minute. Build a simple after-tax model, which includes price, financing, cash flow, and deductions. And document what you're buying and keep the values supportable. Understand how much of the deal is goodwill and what that means for deductions. The purchase price allocation determines how the deal behaves after closing, for taxes, deductions, and cash flow. If this was helpful, please like, subscribe, and comment allocation. And I'll know to share a simple checklist of the categories you should review before you finalize terms.